Welcome back to Trading Wars. This is part 3 of my complete Fibonacci trading course. And today we're going to talk about how to actually enter into the Fibonacci setups with proper stop losses and targets. So previously we've learned how to draw the Fibonacci's, how to look for the impulsive legs. And today we're going to talk about one way that we can enter in the setups using candlesticks. The other ways that you can enter are using limit orders, which is a topic for the next video, which is also pretty lengthy. So we're going to start today looking at entries using candlestick patterns. Okay. So what I'm going to do is walk you through a whole bunch of examples across different instruments. So let's look at the ES with this setup first. So we know that we had an impulsive leg down and we have a retracement here, and I'm going to draw it for you guys. So we have this impulsive leg, and then we know once we get the retracement that we're just looking for these fib levels to be the areas of potential reversal to continue with this trend. So what we can do is we can wait for particular bearish candles if we're shorting on the Fibonacci levels to confirm that the algorithms are indeed trading here. Okay. So when we get up to the 618 zone, we have this first inverted hammer followed by a regular hammer, then another hammer, and then another inverted hammer. So we could see over here there was a lot of rejection. So if you're aggressive, you can just take the first inverted hammer that you see and enter right one tick below the low. So you would have gotten filled on the hammer bar, and you put your stop either right above the bar, or you can put your stop. What I like to do is look to the left, find the next level of resistance, and then put your stop above there so you can give it some more room just in case the market wants to come and wick. Okay. So option one is entering below the low. So waiting for the break of the bar. And then sometimes it's going to be clean where it just rolls over and just collapses. But sometimes you're also going to get these wicks that kind of pull you in, and you need to have good stop losses in order not to get stopped out. So that's why I like to look left, find the next area of structure, and put my stop loss above that. Okay. And then in terms of taking targets, well, the minimum target that I want is at least 1.5. So depending on the candlestick, I know that my first target must be right there. So 1.5-ish right over there. Okay. So I'm going to take out at least a partial at 1.5. And it depends on your style, how much you want to take off, but you should definitely take off some. And when we get to 1.5, we can take the stop loss and we can put it to break even, right? Now we have a risk-free trade. So, and then from that point, what we can do is we can scale out at the different targets. So we can say some at the 272, 382, 50, and then the last piece at the 618. So I like to trade in harmony. If this is reversing at the 618, I want to get out pretty much everything by the 618. Even though it goes down a little further, that doesn't matter because we're just playing the odds over time. Okay, so that's one example of waiting for the pullback of the impulsive leg and then seeing the candlestick patterns. So now let's just go through a bunch of different examples. So here's SPY on the 5-minute chart. And I have a few examples here for us to look at. So the first one is back on October 28th. And we had a gap down and a big push down. And we draw the Fibonacci. And I'm going to draw them with you again so you can see from the high to the low. And this low is, guess where? Around 11:30, 12-ish, right? This is where the market tends to kind of dull out and start to reverse a little bit. And then we start to pick back up when we get to these Fibonacci levels, because there needs to be some relief from this big sell-off, right? So now we pull back into the 50, and then we have a nice long wick here. We have actually 1, 2, 3 wicks of rejection. We have an inside bar and then another inside bar. So we could clearly see at the 50, there's a lot of rejection. There's a lot of indecision, right? So how would we play that position? So we could do the same thing. So we can go here short. So then now we have this double inside bar. So we want to short below the bar. And then we're going to look to the left and we're going to find that there's this nice long bar over here. Put our stop above there. So then we get to 1.5. And in this case, the candles are so small, you get to 1.5 pretty quickly. So we get to 1.5 here. Then we put our stop loss to break even. Okay. And then when we get back down here, what you can also do is when you get back down to the previous area of support, you can look to see if there's a reversal sign. Because if there's a reversal sign, there's a risk that this can become a double bottom and fake you out, right? So then you can also scale out a little bit more at this level. But as you can see, if you were to hang on to this and go back to break even, you're not going to get stopped out. But you would have to you would have to hold right to the close to really hit all of those targets. So look at these targets down here. So the 272 right there, and then the 382, and then we don't make it quite to the 50, but we get pretty close. And then by the end of the day, which is over here, you're gonna make a decision if you want to hold into the next day or not. Okay, so that's pretty straightforward. Let's go to the next example. So this is an example of a long. So we had this short Fibonacci trade, and then the next day we have this little reversal here, this hammer, and now this hammer becomes the low of the day. And once we see this impulsive leg at the open, we can draw the fibs. So this was the open, 9:30. We pulled down and we broke right through. So that's your impulsive leg. So the first thing you want to do is draw it to the first point here before we reverse, right? So then we could clearly see a 382. And then we could see a nice inside bar. So this is actually a call out on Twitter that I did. And then if we were to just enter above this inside bar with a stop below, let's say this little pivot, that's going to be a great trade to take into the close, hitting all the targets on the way up. Okay. The other thing you could have done is done the full. So the full leg, and then again, we pull back to 382. So anytime we pull back to the 382, it's very, and we start to rally, it means that the bulls can't even wait for a 50 or 618, and we can get this type of action where we just rip, because you can clearly see here that they just want to buy every single dip. So again, we have an inside bar at the 382, and then we have another small green bar. So we can enter above the high, and then we can put our stop either back down here at this pivot, or we can just use this wick here. And then again, same thing. So we scale out 1.5, put our stop to break even, right? And then see how we don't get stopped out. So I like doing that 1.5 setup and then going to break even, because it gives me some flexibility. And then we can go back up to all the targets all the way back up there. Okay. So that's pretty straightforward. So the other thing is I want to spend a little bit of time talking about, so you don't have to wait for the candle to break to enter. I like doing that because it confirms the momentum. So you notice like in this little flag that none of these highs get taken out until the momentum changes. That's why I like waiting for that break, because it confirms the momentum has changed. The other way you can enter is just when the candle closes. You don't have to wait for the break. So that's if you're a little bit more aggressive. And if you're super aggressive, like what I teach in my other videos, what you can do is, so let's draw this fib again. Okay. And now let's say this is a trigger entry. Now what we can do is we can do as above, so below. We can go into this candle itself, draw the fib of that entry candle, which is going to be very, very tiny. But if you guys can see that, let me zoom in on that. We have a tag right at the 50. So you could have entered right here with a stop down here, which would be very, very tight, but it would give you the best risk to reward, right? So I hope you guys see that. Those wicks are fibs on a lower time frame, like a very, very lower time frame. We're talking about going down to tick charts and things like that. But that's the power of Fibonacci. It's happening everywhere on every time frame. And here's another very clean example. We have a small gap down. We have an initial impulsive leg down. We retrace the 618, and we have that inverted hammer, that doji, entry below the low, stop above the high, clear winner. Okay, so that's a really, really clean one. And here, I wanted to show you an example of being able to draw the opposing when the initial doesn't work. So here's the initial push long. So we have this. So we get down to the 618 area. We have a whole, it's like you can see the bulls are trying to buy here. So let's say you get filled somewhere over here, and then your stop is down here and you get stopped out. So what do you do next? Well, now you draw the opposing. So we take the opposing from this high to this low. And let's get rid of the original. And then we can clearly see now, again, we have this rejection in the 50 zone, and then we have this big, nice red bar here on the 50. So again, entry below the low, stop above the swing high here. That's a great winner. So you have to be able to adjust sometimes if the fib doesn't hold, but you can see that it's trying. That's the main thing. That's how you know it works, because you can see it's trying. And if it doesn't hold, you can draw the opposing and then take the opposite play. Here's an example on Disney on the daily chart. So we had this low back on coronavirus, 18th of March, this low to this high. We have these wicks at the 50, 1, 2, 3, inside bar, and that was it. Boom, beautiful winner. So if you're able to hold on to these fibs sometimes for like investment plays or swing plays, it could be very, very, very lucrative. The next example I have here is AMD, the daily chart. So we had this big sell-off back on the 2nd of September. We pulled back into the 618 and we got 1, 2, 3 rejections. And we could have just easily taken any one of these candles short, taken it back down to support. And then once we had the double bottom confirmed, we can draw the long leg from this swing low to swing high here. Then we pull back to the 618 again, inside bar, entry, and stop. And then this one is still in play. All right. So just to recap, we know how to draw the impulsive legs of the fibs. And now we can use candlesticks at the levels to confirm that the fibs are in play and that there is a rejection happening. And then we can enter with the candlestick below the low at the close of the candle, or we can use a fib in the candle and we can put our stops at previous support or resistance and take targets according to my style, which is, scaling some out at 1.5, moving your stop to break even, and then playing for 2, 3, 4, and then the fib targets. All right. So I really hope that was clear. I tried to talk very slowly so you guys can understand. And the next video, we're going to be looking at how to be more aggressive with the fibs, how to be going in with limit orders. Okay. So if you learned something, please comment, like, subscribe. I'm a small channel trying to grow, and I'm trying to give you guys all this value so that I can grow. So please do show me some love and help me grow so I can help you grow. All right. Thank you very much. Enjoy your day.